Welcome back to the deep dive. We've gone through the sources you sent, boiled them down, and today we're giving you the essential shortcut. We're looking at what analysts are calling a really pivotal moment for the crypto market. This is late September 2025.
Yeah, pivotal is one word for it. I'd almost call it a collision. You can feel this cautious optimism in the air, right? The charts have recovered pretty well after all that volatility in the spring.
Right.
But the real story, the thing really driving things, it's the regulatory clarity that feels like it's about to spill out of D.C. any day now.
Okay, so that's our mission today. We want to cut through all that noise for you. We'll show you exactly where that market momentum, the price recovery, intersects with the U.S. regulatory action, what signals matter now for the short term, and what decisions are basically locking in the future of the industry.
And let's get the big warning out there right away, based on the material we looked at. The sources are suggesting this current bull cycle, it might be shifting gears, entering what they call the acceleration phase.
Okay, hold on. Acceleration phase? I mean, that sounds exciting, maybe. But what does it actually mean if you've got skin in the game? Does it mean the steady climbs are kind of over?
That's pretty much it, yeah. Predictability kind of goes out the window. Historically, this phase means, a lot more volatility, sharp ups and downs, usually followed by one last really sharp price surge, often driven by FOMO.
Right, fear of missing out.
Exactly.
Yeah.
But the key difference this time is that these market forces, the volatility, the price action, they're smashing right up against specific regulatory deadlines. So the stakes aren't just market high, they're like regulatory high.
That collision, that sounds like the core tension, doesn't it? You've got this strong market push meeting deep regulatory fog. How does that actually show up for the big institutions day to day?
It shows up as, well, paralysis sometimes, or at least extreme caution. The focus, it's almost completely shifted away from just looking at the Fed or macro news. It's all eyes on the U.S. regulators now. Institutions, the really big players, they need clarity from the SEC, from the CFTC. They need that definitive rule book. Honestly, that's the only thing that's going to unlock that, multi-trillion-dollar wall of institutional money that's just waiting to come in for mass adoption.
But it feels different this time, doesn't it? I mean, what I found interesting in the sources is we're finally moving away from just like regulation by lawsuit or surprise announcement.
Oh, it's a massive shift. Huge. Regulators are actually showing they intend to build a clear, functional legal framework. It's like a new era of maybe cooperation. You've got the new SEC chairman, Paul Atkins, on record saying clear rules for digital assets are a top priority. Now, that's not just talk. That sounds like a real commitment to define how this market works, like building the runway instead of just yelling about the cliffs,
Okay, so if they're building the runway, that takes us straight to the biggest piece of legislative machinery in Washington right now. Last year was all about the Bitcoin ETFs, sure. But now, the real bedrock, the thing everyone says will be the backbone for digital finance, it's stablecoins. We have to talk about the Genius Act.
The Genius Act. Yep, that's the stablecoin bill everyone's watching. And the so what on this? It's monumental. Because if this thing passes, it doesn't just allow stablecoins. It actively promotes them. It legally formalizes how they work.
How does it formalize them, though? What's in the act specifically that makes a stablecoin trustworthy enough to be that backbone instead of just another crypto token vaguely pegged to a dollar?
It really comes down to strict federal rules. Think mandatory audits, really clear reserve requirements, like what backs the coin, and giving them a transparent legal status. The whole point of the legislation seems to be making sure the big banks, the financial institutions, can actually trust that a stablecoin is, legally and technically, just as good as a digital dollar for global deals. It takes away that who are these guys risk.
So you've got the regulatory structure maybe getting built, and then on the adoption side, it feels like who is pushing the market forward is also changing.
Oh, it's absolutely changing. Remember when Bitcoin adoption was mostly like maybe some early adopter countries or just retail folks? Well, now we've seen this explosion in public companies putting Bitcoin onto their balance sheets, into their treasury strategy. That number shot up from maybe one or two firms just a few years back to over 75 companies now holding Bitcoin.
75, and still growing. That feels like a huge shift happening almost quietly. But I gotta ask, is 75 companies, is that really enough to sway a market this big? Or is it more of a headline?
That's a fair question. But the insight, what the sources seem to suggest, is that this corporate adoption trend, just the speed and the scale of it, it's actually projected to be a bigger growth driver long-term than even more nation-states deciding to hold Bitcoin as a reserve asset.
Really? Bigger than whole countries?
Why? Because the corporate stuff signals deep operational integration.
That's
It's not just
right.
buying and holding. They're embedding Bitcoin into their financial plumbing,
Yeah.
their processes. That makes it a sustainable, ongoing engine for growth, not just a one-off allocation.
Okay, so that deep corporate integration plus potential regulatory clarity on stablecoins, that leads us to the next big frontier everyone's talking about, institutional DeFi. Now, I think when a lot of listeners hear DeFi, they still think, Wild West, crazy yields, anonymous projects. How is institutional DeFi different?
Yeah, that's a super important distinction. So traditional DeFi, it's open, permissionless, anyone can play. Institutional DeFi, or iDeFi as some call it, uses the same blockchain tech and efficiency, but it's built for compliance. It's often permissioned, meaning only approved, vetted institutional players can get in. It's basically taking blockchain speed and cost savings and applying it within the regulated financial world.
And a huge part of that iDeFi picture is RWA tokens. For anyone listening who hasn't tracked this trend closely, why are real-world asset tokens supposedly going to redefine things?
Right, RWA tokens,
Yeah.
real-world asset tokens. Sounds fancy, but it's simple, really. They're just digital representations, like digital deeds or claims for real stuff, like physical property, maybe a portfolio of loans, even shares in a private fund. Imagine taking, say, a $100 million building and tokenizing it, creating digital shares of ownership. If we get positive regulatory moves, especially around tokenization itself, this market could just explode. It lets TradFi use blockchain for efficiency without fundamentally changing the underlying assets.
Oh, okay. That covers the big picture, the long game, the structural shifts. Let's zoom right back in. People need to know what might happen now, next 24, 48 hours. While we're all waiting for this clarity, what's the immediate forecast for Bitcoin and Ethereum?
Right now, sideways. Pretty much sideways movement expected,
Yeah.
probably in a fairly tight range. Feels like a holding pattern. Traders are looking over their shoulders at the macro picture, waiting for clearer news from the Fed, maybe Congress, before making big moves. The market's kind of holding its breath, really, waiting for some kind of regulatory spark.
There is something positive happening under the surface, right? Something concrete. Tell us about those ETF flows.
Yes. This is where you see the institutional sentiment really coming back. The latest data is pretty striking. We saw a net inflow of over $1 billion into the Bitcoin and Ethereum spot ETFs. Just in 24 hours.
$1 billion.
$1 billion, yeah.
Yeah.
And Fidelity was apparently a big driver of that activity.
Okay, $1 billion is definitely not nothing. But how significant is that compared to, say, past outflows or when things were really crazy volatile?
It's significant now because it breaks a pattern. We'd seen weeks of outflows, money leaving. This inflow suggests institutions aren't just thinking about getting back in, they're actually putting capital to work right now.
Yeah.
They seem to see this price level as a decent entry point before whatever regulatory news drops.
But the sources also warn that even $1 billion isn't quite enough, not yet anyway, to punch through the current resistance levels.
Exactly right. Despite that big inflow, the technical charts still show Bitcoin bumping its head against significant resistance. The consensus seems to be it needs a real strong external push, like a positive vote on the Genius Act, or a major policy clarification from the SEC to actually break out of this current range.
So in this kind of environment, cautious, waiting on regulators, who benefits right now? Which altcoins are looking good? Let's talk winners.
Well, the immediate winners are generally the ones seen as safe or, aligned with where regulation seems to be heading. So stablecoin projects and real-world asset RWA tokens are getting a lot of positive buzz. Why? Because they fit the regulatory narrative. You even have comments from influential people like Fed Governor Christopher Waller, SEC Commissioner Hester Pierce, kind of nodding towards regulated asset-backed or utility-focused crypto stuff.
And if that Genius Act actually starts making progress, that's good news for other Layer 1 blockchains too, potentially, not just Ethereum.
Oh, absolutely. Think about it. If the act passes and encourages compliant stablecoins, where are those stablecoins going to live? They'll want to be on multiple efficient networks. So that dramatically boosts the use case, the transaction volume, for Layer 1s that compete with Ethereum. Their value proposition gets a lot stronger if they can reliably host all that regulated financial traffic.
Okay, now the flip side. Altcoin losers. Which types of projects are feeling the heat right now?
The pressure is all about compliance risk, really. DeFi projects that don't have a clear path to fitting into the rules, especially ones focused on anonymity or, super high leverage, they could face sell-offs. Even on slightly bad regulatory news, it feels like the market's trying to shed that non-compliance risk pretty fast. And then there's just the general pressure from Bitcoin dominance creeping up. That tends to suck the air out of the room for many alts.
Right, BTC dominance. That's a perfect transition. Let's talk about the three essential metrics that you, our listener, really need to keep an eye on daily to navigate this acceleration phase.
Okay, metric number one, we just touched on it, ETF flows. Don't just glance at the headlines. Watch the daily numbers if you can. They're probably the closest thing you have to a real-time gauge of what the big institutional players are feeling and doing. That $1 billion inflow, that wasn't random noise. That was likely smart money positioning itself.
Metric two, the classic sentiment check, the fear and greed index. What's the mood of the market right now, according to that?
Sitting at neutral 50, which is actually an improvement. It was down in fear territory, around 43 just last week. So the context here is key. The market isn't panicked anymore, but it's definitely not reached that greed or extreme greed stage yet. If you see that number suddenly spike up, say into the 70s or 80s, that often signals volatility is just around the corner because maybe the retail crowd is getting overly excited again. Keep a close eye on sudden jumps.
Got it. And metric number three, BTC dominance. You mentioned it's creeping up. Where is it exactly?
Right now, it's hovering around 58.1%.
And why is that specific number or range so important for analysts?
They watch it obsessively because it shows where the money is flowing within the crypto space itself. Is it concentrating in Bitcoin or spreading out? At 58.1%, Bitcoin's still commanding a huge chunk of the market cap. If that number were to fall significantly, say down towards the 40–42% region, historically, that's been the signal for a potential altcoin season.
Where money rotates heavily into smaller coins.
Exactly. But as long as BTC dominance stays high or keeps rising, it tends to put a lid on broad altcoin rallies.
Okay, so navigating this acceleration phase clearly requires some serious risk management. If you're not ready for sharp moves both ways, you could get caught out.
Absolutely. Quick strategy reminder, especially for you listening, keep that portfolio diversified. Don't put all your eggs in one basket. And please, seriously consider using risk management tools. Things like stop-loss orders, they automatically sell if the price drops to a certain point. In a phase like this where sudden drops are basically guaranteed, they can be lifesavers for your capital. Can't stress that enough.
Right. Beyond the charts and the crypto metrics, there are also these big external events we need to track, especially heading towards October 1st. Pure political and macro stuff. What's number one?
The biggest immediate political risk is probably the potential U.S. government shutdown. If Congress can't agree on funding, a shutdown could gum up the works, delay regulatory decisions we're all waiting for, maybe ETF approvals, maybe progress on bills like Genius. It just injects uncertainty into all financial markets, and crypto really doesn't like uncertainty.
Okay. Number two is about tracking the regulators themselves more closely.
Yeah, you have to keep listening. Monitor every statement, every little hint coming out of SEC and CFTC roundtables or speeches. These market structure bills, the Genius Act, they're not set in stone yet. Any sign of progress or unexpected roadblocks could cause an instant market reaction.
And the third factor is just the broader economy, the Fed watching.
Still got to watch the Fed. We're always analyzing signals on monetary policy. Vice Chairman Jefferson spoke recently. People are parsing that. End of the day, crypto is still mostly seen as a risk asset. It's sensitive to overall liquidity. If the Fed sounds like it's going to tighten things up, that'll likely push crypto prices down, even if the regulatory news is good.
Okay, so let's try and wrap this all up. This deep dive shows we're in this really unique, sensitive spot where getting structural clarity from regulators is like the ultimate goal. Patience, staying informed constantly. That seems absolutely critical right now. Regulatory decisions seem poised to shape the long-term trends way more than just short-term price action.
I think that's right. And if you connect those dots, we talked about the acceleration phase idea, the shift to corporate adoption being maybe more important now, those 75-plus companies, and this intense focus on the Genius Act, it really feels like the final stages of institutionalization are knocking at the door.
So here's the final thought we want to leave you with. Analysts seem to agree we're heading into maybe the last big surge phase of this cycle, and that surge is probably going to be kicked off by some kind of regulatory event. Now, given that corporate adoption seems to be outpacing even nation-states buying Bitcoin, what specific regulatory domino, maybe the Genius Act passing, plus some clear rules on tokenized assets, what combo could be the exact trigger, the one that sets off that final explosive acceleration? What specific regulatory development are you watching most closely right now?
Because that answer likely determines where the smart money flows next.
Lots to think about. We'll see you next time on The Deep Dive.